Welcome back. This is part 3 of our special May series on point and figures. And again, Bruce Fraser is back with us for this session. Today, we are going to talk really quickly about point and figure counts as a timing tool for the stepping stone ranges. It's probably one of the most exciting tools or ideas in point and figures for the horizontal count, because you really can introduce the element of, so to say, time, or when the price is ready to leave the stepping stone. So that's going to be interesting to go through. And then we're going to just dive into case studies. We're going to first look at the case study of the Dow Jones Industrial Average. We're going to talk about the counts. We're going to talk about the current picture. And then Bruce is going to walk us through his case studies where, he either followed the stock or had a position in the stock. And we'll discuss very interesting nuances. Specifically, we'll talk about the counts on the distribution and how different they are in terms of how much of a count you want to project. That's a very interesting aspect. Then we're going to also look at the case study with the intraday point and figure data. And I thought Bruce had such a great approach to that, so I'm looking forward to that. Anything else, Bruce, that I'm missing?
Let's get started.
Let's get started. Okay, great. Okay, as usual, this session is for educational purposes only. All right, so we've talked about, let's kind of like review maybe a little bit of what we've covered so far in the first 2 sessions. So we've talked about why we want to use point and figures. For many reasons. One of the main reasons is obviously to understand what kind of effect that a trading range course will have on the movement in the trend. We've talked about how we would take that count. That counts could be conservative, aggressive counts, and they need to start specifically at the specific places in the trading range. We've talked about different mix counts where trading range falls into different box size territory, and we have to account for that when we do the counts. We've talked about phase analysis, point and figure analysis, phase analysis, where we identify potential stopping actions in the uptrend or downtrend, and where the stepping stones can occur. And I think that's it, right? So today, we want to continue, and this is going to be probably a 15 to 20 minute segment. We'll talk about point and figures count as a timing tool that we can use during the stepping stones ranges. So right here on this chart, this is our Apple case study. We see that we have 4 phases, and our assumption that at the end of each phase of each count, and we have the counts here, and this is the final count right here. At the end of each phase, when the price reaches this objective, or it's close to that objective, there might be some kind of stopping action. And as we go through this stepping stone, and if we know the final objective right here, so let's say that we're in phase 3 right here, we can actually, knowing the final objective, calculate how many columns in this stepping stone range we should have before the price is going to leave this trading range. And let's just quickly go to the next slide. And this is a hypothetical example right here. So let's imagine that we have a trading range that has two phases, X1 and X2. The count for the whole trading range has an objective Z right here. And then the phase 1, X1, has a low objective right here. So once we are starting to have, once we've reached the objective for the stepping stone, and we're just going through a consolidation right here in this area, we already know what the final count is going to be for us. And we know that from this price, we need a specific number of columns to be built in this trading range in order for the price to leave and to reach this objective. So in other words, as the price unfolds right here, and if we know how many number of columns, so let's say double X columns need to be built, as we approach the end of the trading range right here, this tool of the, on the point and figures can help us out to identify and approximate the area where the price will should be already, supply should be absorbed if this is a reaccumulation, and the price might be on a springboard at this moment, and it's going to be ready to move. Bruce, how would you describe this tool? And maybe if you could talk about more about the benefits.
It's, you know, I think of point figure as being one of the really great edges that we have in markets, and very few people know how to use point and figure. If they do, they're probably using a vertical methodology rather than doing horizontal counting like we're doing. And so the only reason that we can do this type of analysis, which you just described, is because we're doing horizontal counting. And so we can take a count, and sometimes that reaccumulation range will go to the X1 count. Sometimes it will be just as it jumps out of the accumulation range. Sometimes it'll be 2/3 of the way up. And as we can see from the Apple example, there could be multiple of them along the way. So it can happen a number of different ways, and it's always slick when the phases, phase 1, 2, 3, 4, matches up with our stepping stones. But it doesn't have to happen. So the aspect of this where we can do timing is something that really was championed by our mentor, Hank Pruden. And Hank has been a big advocate of using stepping stone reaccumulation counts as timing tools. And so what we do is when we are in a stepping stone and we have higher counts ahead of us, what we'll do is we'll actually mark on the chart out in space, out in empty columns. We'll mark where the stepping stone will go, how many columns out. Maybe there's like 30 total columns in a stepping stone, and we're 20 columns into that count. And when we get to 30 columns across in the stepping stone, that's where the count in the stepping stone matches the base accumulation count, and they both match up at higher prices. So we actually will take and mark on our chart out 30 columns out where the stepping stone count will equal the accumulation count, and then we will look for the stepping stone to continue to progress over to that those 30 columns. And somewhere in the neighborhood of 30 columns, it'll start to prepare itself to jump out and start its next uptrend. And I just think that's just such a nuanced tool, and it happens over and over and over. You see this kind of a phenomenon repeatedly. And so things that happen, these are other things that you can do if you know roughly at 30 columns that it's going to jump out and start to continue its trend upwards, is that you can start to look for either a spring type action, or you can look for some kind of a move from the top of the trading range back towards the bottom. Maybe it doesn't spring, makes a higher low, but you look for signs of absorption, pullbacks on very light volume, which tells you that you're just about ready to start running again. Things like that, things that we learned from doing vertical chart analysis in Wyckoff. And so we start to get 25, 26, 27 columns in, we're on our toes because we're on alert that this thing this stock is getting ready to jump. And so it's a great tool.
All right, great. And I want to stress again what Bruce said. As the number of columns approaches the number that we're looking for, we are looking for the evidence that, let's say, reaccumulation has occurred, that supply has been observed, and it's there in that area. We're going to look to establish the position in this stepping stone. So let's just quickly go through one example right here. And this is why phase work also is so exciting, because as you have these targets, I have this target number 2 right here. So let's assume that we are looking at these two targets right here, 137 and 176, and we are somewhere here. I'm looking at this reaction as the largest reaction in this upswing right here. So what does it mean? That means that it's a change of character and we are done with this upswing. And we potentially can have a consolidation. Now this consolidation is a little bit irregular because we have a big upthrust right here, upthrust action, and then another reaction. So instead of being, more horizontal and more reactionary like this, it's just, upslope, and it just shows the strength. But this was the change of character that suggested that sideways action. So now our second phase objective here is 176, and the difference between two objectives here of phase 1 and phase 2 is 39 points. Because it's a 3-point reversal, we want to calculate how many boxes or how many columns should we have horizontally in order for us to go through this whole consolidation and to build enough cores for the price to travel to the second objective. And we take 39 points, we divide it by 3, we get 13 boxes of 13 columns. So starting from the change of behavior right here, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So somewhere in the area of the 11, 12, I would be very alert as to what are the signs of reaccumulation that we have had here. Is the stock still outperforming? Is the stock on the springboard? Is it ready to move out of the trading range? And we would be looking for those signs. And obviously, columns 11, 12, and 13 would be our focal point.
Well, and notice how there was a spring type action in column 13, 12, 11, 10, it looks like. So here you have the spring type action, and then it goes up, comes back down for a test, and that test comes on the 13th column. So okay. There's just great action there.
Yeah, and that's basically it, Bruce, right? Because I don't think that this is a very complicated, math here. As long as we understand how to correctly identify, the objectives for each phase, we can conduct this type of analysis and we can use point and figure counts, horizontal counts as our timing tool, which is just unbelievable tool to have. And in this second example, we're going through the same calculations. So we're looking at the next phase target right here, 215. We are taking, identifying the difference. It actually turned out to be the same 39 points. So it's also going to be 13 columns right here. This reaction right here, this consolidation is a little bit upsloping here. So counting from here to here, here's our 13 columns. And it's not very, very exact in this case, in this second case, but it's still very close. I mean, you can, thinking about 13 columns, you might go into column number 8 to number 9, and you have to remember that it's not a daily action. It's not a weekly action. It's a function of the price volatility. So you might have one column developing, for some time. So you really have to look at the point and figures to identify a number of columns that are unfolding in the current trading range. And then somewhere around column number 8, 9, 10, you have to become alert as to this is the time when the price should start behaving as if it's on the springboard. Okay, Bruce, anything else here?
I think we may see some other similar examples, but that's a great explanation.
Okay. And here is one last slide on this concept, and I just created this slide because I wanted to show a different, more complex scenario where we have the trading range, like Apple trading range here that we looked at, and we have multiple phases that we can find. And in some instances, we don't know how the stepping stone is going to unfold. We might have two phases right here unfolding, let's say phase 1 and then phase 2. And so we don't know how things are going to unfold. But whenever we have a scenario where we have, let's say, enough cause right here, in this case for the last two phases before the final objective is reached, and we are coming close to the end right here, we know already the final count. We know how many columns we have to create in this area of consolidation for us to create a stepping stone count that will match the price movement to the upside to this objective right here. So somewhere here in this area, we're going to be extremely alert, and we're going to, start looking for the evidence of supply absorption and any bullish signs. All right. Well, I think that we've covered that. That was really quick, Bruce.
Good.
Okay. Any last thoughts that you might?
I think some of this is actually going to come up as we go further along.
Okay.
So
yeah,
this is a good primer because we're going to be seeing some other examples as we go.
All right. Great. Awesome. Okay, so let's go to case studies. This is what we are here for primarily, and we're going to start with a case study that was published by Hank Pruden, Bruce Frazier, and myself in Stocks and Commodities magazine. For those of you who are interested in receiving an article, I'm actually going to email the link. I kind of forgot to put it on the slide, but I'll definitely email you the link to that article. So at the time of the article, we were somewhere here. That was 16,000 on the Dow. So we're clearly much higher, or much higher right now. And we wanted to look at the original trading range, and we wanted to project all of the counts, and then to look at the stepping stones and to confirm those counts. So this picture is a little bit outdated, so we've created this new picture right here, which looks at all of the original counts, stepping stone counts, some confirmatory counts on the way up, and also there are two scenarios that we've put here for us to look at from the perspective of the point and figure count. A bullish scenario, continuation of the uptrend, and a potential short-term distribution here. So we'll go through all of them. And Bruce, let's start with the original trading range right here.
Just a step back for of just a minute. There's a sort of a history behind this analysis, in that Dr. Pruden, back in 2001, 2002, 2003, had done this analysis on the accumulation phase that occurred prior to that bull market, and he took a count, and the count, and then projected it upwards, and it counted to this unbelievable range of around 14,400, and then he wrote an article about it. And we talked about it in class, and the projection at the time, because we were just coming out of a bear market and a severe bear market in the NASDAQ, but he did the analysis on the Dow, was just a pie in the sky number. It was just an unbelievable number. And so he did this analysis, wrote this article, and the count that he had was 14,400 was the final count that he could, the analysis could get to, and the Dow topped out at just under 14,200. And so it was a remarkable call, and he made the call when we were literally in the first leg out of the accumulation phase in 2002, 2003. So you should actually go back and look at that, and maybe we can find that chart to illustrate that. But so Hank wanted for us to do this analysis again and do it on this market and come up with some objectives for how far up this market could go. And so this is sort of the inspiration for this analysis was that original 14,400 analysis that he did over 10 years ago.
And also for this trading range, I believe that Hank was actually writing the original article somewhere here in this period. So once the trend was confirmed, he was taking the objectives and he was talking about, 17,000 on the Dow, during this time right here, like mid of 2009. And I think it's very remarkable.
Sorry, you cut out there. I don't know if that was just me or.
Oh, okay. I think it's remarkable, Bruce, how just early after the confirmation of the trend, he was able to take the count and start looking, at the objectives that were so high.
Oh, it's unbelievable. It's just, at the time, nobody could believe these counts, that the market even had the potential to get to these types of lofty levels. And he did all this with horizontal point and figure counting. The basic point and figure counting that we're learning in this in our sessions.
All right. Well, let's go and decipher those counts. So this is kind of like a little bit fresher look at the whole campaign since 2008, 2009. So let's look at the original trading range, and let's look using the count guide. Obviously, we're going to go to the vertical charts right here. So Bruce, do you want to walk us through here?
Well, and this is what I did was from this article. I actually did a talk up in Seattle where I actually went through the vertical and the horizontal, or the point figure charts and counted each of the progression of the accumulation and then through the stepping stones. And so this is what we're looking at. And you can see here that basically we're taking and identifying on this vertical chart the last point of support, which is that point where we have one last pullback before jumping out and starting the uptrend. And this comes after a very dramatic shakeout in phase C. And that shakeout is unique in my experience because shakeouts are more common 100 years ago in the big indexes than they are today. And so this shakeout was quite dramatic. And so we take our count from, as we recall from the count guide, from the LPS over to either the climax or to the preliminary support. And you can see here that with what I've labeled the climax, and I believe that that is the climax, is the most apparent place to take our count to. So we get our points on the vertical chart, and then we go back to the point and figure chart, find those points on the point and figure chart, and we can see there that Ramon has identified those points on the point and figure chart. And you count across. What is this? This say this is a 100-point scale
was the
3-box reversal.
3-box reversal. Mm-hmm.
Okay.
So we had 37 boxes on this line right here, and we have 2 lines, right? So, and maybe we should just quickly, by going through this example, just review really quickly how we would, go through the counts here. So Bruce was talking about identifying that last point of support or backing up action. And this is this line right here. It's 8100 line. And we are calculating the number of columns from right to left from this point, last point of support, across the whole trading range to the climactic action. So there are 37 boxes. So now we are set, in our math here, we have 37 boxes times 100 points per box, 3 box reversal, so it's all multiplied, and we are having the maximum objective on the 8100 line. So we're getting 19,200 as our maximum objective. Because this is a trading range where we have the extreme highs and the extreme lows, we have to look at the lowest price in the trading range, and that was this shakeout action, and identify the line, the lowest line where we would take this count, the same count. So we have the same 37 boxes times 100 times 3 on the 6500 line, and that gives us an objective of 17,600. We also would like to identify half point between the maximum and the minimum objective, and then we're just projecting it, and here is our our objectives here. And please note that 17.6 has been reached, and we'll talk about the confirmations, but this objective obviously has been reached. All right, Bruce?
Great.
What would we do next? So we have this original count.
Well, so the next thing we would do is we would look at the next stepping stone count, or evaluate whether or not we want to take a bigger count. I don't know if you want to do that now, because you have a major backup after a jump.
Right. Well, I would let's go exactly how we would do this as the price unfolds here in front of us, right? So we're having this upswing right here, and we're thinking, okay, well, our objectives are too far away. So we're going to have probably multiple stepping stone areas where we want to confirm the final count, or we want to confirm a stepping stone to a stepping stone count. So the next consolidation comes right here with the count number 2. And, we would calculate the same way. We would look at the consolidation. We would look at the last point of support right here, last attempt to retest the lows of this range. We would have 11 boxes. We would have our minimum and maximum objective. And Bruce, the price projects 13,300 and 13,000. So this area right here, we obviously undershooting, but to me, it still tells me that the count actually works. I'm actually always looking for this confirmation that if I take the count, my scaling here works really well. It's not a big underreach for the objective here. I mean, we are literally from the minimum target here, probably 100 or 200 points away.
Yeah, that's a very good.
So we want to look for these confirmations when we are seeing the consolidation, and then it just gives us this stop in action near the price objective right here. And then to the downside right here, we're calculating, and it goes exactly to this area right here of the spring for this stepping stone. So 2 counts right away that are giving us somewhat accurate measurements for swings. And that gives us a lot of confidence that this is the right scale for this particular chart, that the accounts are working really nicely. So it gives us a little bit of confidence, to actually think about our long-term objective right here. All right, well, Bruce, let's talk about the next big stepping stone right here in this area, 2011. Should we go to the vertical?
Do we have? Yeah, let's just. Okay, so here you can see that it's already has a dramatic sign of strength where it jumps. This was actually some people consider this to be a mini bear market, and so the break that we had, which culminated in a selling climax in an automatic rally, it's a pretty dramatic decline, and the volume is very high. And then you have a really nice spring that comes over in October, and that spring, I call springs the cathartic moment, and it's like where you just clean out everything. You just wash out the lows. You anybody who is trying to be long the market gets stopped out. It's just it's a very difficult thing, but a spring is that moment where the whole character of the market changes, and you can see that right after that, the prices just go right up through the trading range called the accumulation range, or a stepping stone, and makes a major sign of strength, and then comes halfway back into the stepping stone. And so we can recall that that was one of the things that Wyckoff looked for, was a market to pull back. He would expect the market to pull back into the range, but he would not want it to pull back more than halfway into the range. So we take from where Ramon has drawn the stepping stone range, and you can see that it gets close to halfway, but it doesn't quite get there, which is bullish. That in and of itself is a type of a sign of strength, is the fact that it couldn't pull back into the midpoint. It could get near it, but it couldn't get there. And then it comes out, and it starts its uptrend. So that pullback into the midpoint is the LPS. So we have an LPS, and we have a selling climax, so we can identify those, and we can see that there's an inset down here of the point figure of the stepping stone, and we can see that there's a count there across. which we can go back to Ramon's example, but there is that point and figure. So now we have our points to take the count from, and we can see there that it's 23 boxes times 100 times 3, and darn if that isn't match the midpoint of the accumulation range count that we had back in the accumulation. And so
you're talking about this number right here. So
the 18,200 matches goes up into the midpoint.
Yeah.
But yeah, the 17.8 halfway point is 200 away from the minimum objective in the accumulation range.
Mm-hmm.
So
Okay, Bruce. Well, let's stop here because I think it's again, to me, the phase analysis, the stepping stone, this is the value. So why is it so important for us to see this confirmation on the stepping stone for the original counts?
Well, it's a dramatic confirmation of this huge count that we have in the accumulation range, and the fact that we have a stepping stone that matches the very large count, which is taken across the 8100 line. I mean, we're talking about making a projection at the 8100 line for a potential to go to 19,200, which nobody's going to believe that. We could go to 100 analysts on Wall Street back then, and we could find maybe one that would go, that's possible. And so they were all looking for the bear market to resume, or that the markets were permanently broken. There was so much pessimism. And so now we turn around, there's still pessimism back in 2011. Mm-hmm. And so now we turn around and make another base and exactly count up into the large count in the accumulation range. And at that point, the market starts to jump out and begins its markup again. And so it marks up to another level. And so this is a very dramatic example of a stepping stone. And it confirms what we've already got marked on the chart.
It's so interesting how the confirmation comes after confirmation. So as we go to the next one, as you said, look at the objective here, 17,400. Well, here we have half a point, a middle point here for our objective at 17,800. At the original trading range, the minimum objective is 17,600. And then the next one right here also confirms the same target. So when you have so many multiple confirmations, it's like screaming at you that it's going to be an important area, a significant area, whether either the trend is going to stop and reverse, or it's going to stop, consolidate, and then create the new count to the new objective. So I thought, Bruce, that this is just such an excellent case study where everything so far is working extremely well. And we definitely have an interesting discussion about the current trading range right here. And in preparation to this session, we were discussing how would we approach this topic, and we decided that, as usual, we don't want to be biased one way or another. We want to talk about both scenarios, bullish and bearish. So let me walk you through a bullish scenario first and talk about the counts, and then Bruce will talk about some potential signs for the distribution and how would we handle this and how would we use the point and figures for that. So on the bullish scenario, and obviously we can talk about how the price is breaking out right now and it tries to break out, And in a lot of instances, we see that there is not a very good confirmation by the volume, on this breakout. So when we see that, we might be thinking that this could be a potential upthrust action. But from the perspective of the trend, even in the very classical definition of the trend, where we have higher highs and higher lows in the trend, we are still in the uptrend. Nothing has changed. No matter how we're going to look at this, long-term or intermediate trend, those are still up. And you see here I put the trend channel just to identify where the price spends most of the time going up. So from that perspective, we're still in an uptrend. If we would be thinking that this area right here is an area of reaccumulation, then we would be looking to finalize our count. And I'm taking this count right here across the whole consolidation, and I'm using the last point of support right here before the price started to travel up, into the breakout situation, and going from right to left across the whole trading range. And it gives me this count number 7. And, I put here if market confirms the breakout, so we need to commit to the upside. The preferable commitment would be on expanding volume. And after that, we'll have a backing up action, which will see the contraction of the spread, contraction of the supply, and then continuation, resumption of the uptrend. So if those conditions are being satisfied, then we can definitely talk about this count as being a legitimate count. So, but what does it give us? So we have 19 boxes here, and the maximum objective and the minimum objective fall between 22,000 and 23,500 right here. So the next question to ask is, have we maybe missed something in our original count? How can we find a confirmation for this target right here? And if we go into the original trading range, then we'll see that there's definitely been one big upswing since the lows of the shakeout, and the price was going up, and then there was a big change of character right here that suggested a consolidation. And we see that if we would use horizontal resistance right here, defined by the automatic rally, original automatic rally, we will see how the price commits to the upside, which is an element for the sign of strength, and then changes behavior, suggesting a consolidation. And the price goes down and starts testing what now acts as a support, but it was the previous level of the resistance right here. And we are observing a trading range, which is just a major backing up action at this point. So from this perspective, if we are thinking a major sign of strength and then a major backing up action, we can take a different count. We can take a larger, more aggressive count from the lows in this backing up action across the whole trading range into the climactic action column right here. And we could see that this count right here, which is count number 8, and I call this the aggressive accumulation count, has 53 boxes. And on 2 different lines, the maximum and minimum lines, it gives us 25,000 and 22,000, which is so close to these numbers. So the midpoint of 24,000 here for the Dow is actually extremely close to all of these points right here. So when you see this type of confirmation, and let's say if the market gives us sufficient information right here at this point that the breakout that we're having right now is solid, it's not a fake, then and as the price starts going up, resuming the uptrend, these are the objectives that we would be looking for the price to move to. And it's very nice how from the original trading range we have the objective that is being confirmed now by this new stepping stone right here, if this is, again, if this is a reaccumulation. So that's a bullish scenario here. Bruce, I know that you've done a lot of work on the distribution and the, the point and figures counts for the distribution. How would you look at this as a potential distribution? And by the way, what are the elements, traits of this latest trading range that you see as potentially being a distribution? Could you give us some examples?
Sure. So I completely believe that the counts that Ramon just highlighted are possible. And and we must go with the idea that this is a confirmed long-term uptrend. But there are some things that I see in this that I think we ought to consider for our tactics, because we always want to think in terms of tactics. We don't want to have we don't want to become so concretized in a point of view that we can't be flexible. And so we see here that we have this large stepping stone, and notice that and I'll try to put this in Wyckoff-ian terms. I like to think about the composite operator and try to have a narrative that sort of supports what the composite operator is doing. Well, notice how in this stepping stone that the market has become very tight and quiet and is trading up at the top of the range. It just keeps, it's living at the top of the trading range and just keeps pushing up, pushing up, pushing up. Well, that is an opportunity for the composite operator, but it's an opportunity for the composite operator to sell stock. So they've had repeated opportunities in this dull and quiet market to be able to put orders over the market and sell stock. And in fact, every time the market gets up to that 18,200, 18,300 level, they turn it back down, but they keep it in the top half of the range. I find that to be very suspicious. And I know a lot of people find comfort in that, but I find it to be suspicious. And the reason to give you sort of an alternative view here is let's go all the way back to 2010 and look at when we had the major sign of strength and the major backup, which and so you can see that really quite the opposite condition was occurring there. That what was happening was that the market kept literally banging its way back down to the bottom of the trading range, and more or less living in the bottom half of that stepping stone reaccumulation, which actually makes people quite bearish. And so the fact that the market couldn't lift itself up and just kept spending time down there, well, that was an opportunity for the composite operator to accumulate shares. And so we want to think like the composite operator. We want to think in terms of their narrative, think about what they're doing and their orientation, and they're accumulating shares throughout the accumulation and in this stepping stone that we're looking at, because they see much higher prices ahead. They may not be doing horizontal point figure counting, but they have a reason to believe that there's much higher prices out into the future. And so the CO has just a tremendous opportunity. So now we get over to the next stepping stone, and you can see that the last thing that this stepping stone does after it climaxes, sets the range, and then the last thing it does is it jams all the way back down to the bottom and springs the low. And then once it's done that, it can start to mark up. So the next stepping stone, which is in 2012, you can see that this one can't get back to the lows, but notice how it comes out of the top and puts in an upthrust, and then it has a very sharp decline that goes down not to the lows of the stepping stone, but goes down far enough that it's disconcerting to the average investor. And so Then we go to the next stepping stone. Well, look what happens in the tail end. It springs the lows, and then there are 4 more columns, and look how volatile this market gets with these dramatic swings back down to the bottom of the trading range. Big dramatic swings to the bottom of the trading range. And then it turns off of that, jumps out of the stepping stone, and starts its markup. So my thinking is here, as I look at this, that it's actually the complacency that's coming with this would make me believe that there's a couple different scenarios. One is it's distribution. I'm kind of, it's possible. I'm never going to rule out a scenario. Mm-hmm. But the other possibility is that they take this market back down to the towards the bottom of the range, maybe that 17,000 level, which is and put in a spring, and then they take it up and start to mark up to 23,000. Or the other thing that we have is we have a much bigger stepping stone that's going to occur mm-hmm. here before we can turn around and go. But I do think those are possible scenarios. Mm-hmm. And then Ramon just took the first segment of that count up there, and which we want to be conservative in our distribution counting. And that count took you down to around 16.2. Yeah. And so there is a cause built that could result in a decline. And now that we've broken to a new high, we need to see the market just continue to follow through and just start marching up from here and getting away from this level to be able to confirm that, in fact, this is a good stepping stone mm-hmm. and that there doesn't need to be another shakeout of some kind before a real up move can start.
Mm-hmm. Yeah, I like this logic. I like this thinking. In our market outlook class, we obviously look at both scenarios. So it's the confirmation, as Bruce said, marching prices up. Even if we will not see, and which could be also very misleading on the way up, if we don't see increase of the demand, but the price is still going up, people usually would start thinking and saying, but there is no volume to confirm this move. So such our advancement of price to the upside without a lot of demand is only a function of the low supply. So if that would be the case, we have to seek the confirmation in what kind of quality of the supply we have, how much on the way up, is it decreasing, is demand persistent enough, to reverse the supply trend and, to push the prices higher. So if we see all of that, then these targets are going to become very much relevant. I like Bruce's scenario here to the downside, because even if we're going to have, Bruce, some kind of spring or shakeout action right here, this still might produce a higher low relative to the October low right here.
Oh, absolutely. And it may do nothing more than get down towards that 17,000 level where there's two right. prior down columns mm-hmm. that
and it
might
build
get
for
to
us.
it or spring it. But notice how in each mm-hmm. one of these prior that they take them down before they take them up.
Yes.
It's one of the last things they do is to take them down really hard before they take them up. Mm-hmm. And so I wouldn't expect this to be any different than that.
Mm-hmm. Okay.
If it does happen that way, I'll be pleasantly surprised. I'll be happy with that. Mm-hmm. Except that if it happens the other way, where they have to scare people out to start the move, that certainly wouldn't surprise me.
Mm-hmm. Okay. Also, I like this scenario from the structural perspective, because if we're going to create this new higher low right here, it could be of the same magnitude as the low in 2011, and basically it could be the same magnitude reaction or being somewhat close, and that will expand our trend channel, and that way we have first move to the upside, second move to the upside, two reactions in between, and then continuation of the move, and maybe a more speculative market as we are marching to the new, overcoming any resistances that we potentially can have. So that makes a lot of sense to me, just to end our, this kind of like cyclical secular move in somewhat of a speculative phase, overbought conditions, everybody's excited, everybody wants to come in, invest in stocks, and then, composites, it just starts distributing at the higher level. Okay, question, Bruce. Why isn't the distribution count at current market level not going to the preliminary supply, which would give us a larger downside objective? So
that's a great question, and I think that we're going to kind of answer that question as we go through some more examples.
Okay.
But just for now, let me try to answer it this way, and that is that it's very easy to overcount distribution. And distribution is very tricky, and it's different from counting accumulation in some important ways. So our tendency is to undercount accumulate or distribution because you'll find that if we take this count, how many columns across is that? If we were to just take that as 19 boxes across, and then
times 3
times 3 times 100, and then we were to take a distribution count.
I can give you
5,700 points.
And
so, it might be that we go down 5,700 points from here, but it's more likely that we're going to do something far less than that. And the whole key to distribution counting is we want to count it in a way that we have confidence in it, and there's the potential for accuracy. And so 5,700 point drop from here, maybe it happens.
Would go right here.
Yeah, maybe that happens, but at least in the near term, there's going to be a smaller move down. We want to count that smaller move, and then take another look at the big picture. We never discount the possibility that those big counts could happen. We always have them in the back of our minds, but we try to count as accurately as we can for the near term. And we'll see examples of that. So as we go.
Absolutely. Okay.
Good question.
A good question. Yes. Okay. Well, I think that we've covered everything on this chart. If
nice
we have,
chart. You just did that this week, and we all thank you.
Well, it was a lot of fun, to go through this, just to refresh all of the objectives, and then to look at the different scenarios. So
you're going to see my point figure charts, the ones I make, and you're going to see the ones that Ramon makes. And he should sign them and frame them and put them on the wall. Mine, you put them down where the cat can use them.
Okay, Bruce. Okay.
You'll see.
But the discussions that we're going to have on your slides are going to be amazing. So let's go to your slides now, right? So we finished with.
Let's just tell everybody. Yeah, let's go back a slide.
Okay, hold on a sec. Which one?
This one and the one before it, and just that these are the other stepping stones that were vertical charts of the other stepping stones, and you can study those on your own and see where we took counts from and how we got our counts in the point figure analysis. And so we have inset inside the point figures, and so you can study those on your own, but same concept as the other two that we did look at.
Okay, great. Let's talk about something else. Let's talk about something completely different time frame. So as we were going through some slides in preparation for this session, you talked about going and zooming in into smaller details when you're looking to establish a long-term position. So, and effectively, you go sometimes to the intraday data just to identify, whether it's a reversal in the market of the swing, up or down, or for the stock, to identify that reversal. So this is a chart, intraday chart of the Dow Jones Industrial Average. Bruce, could you walk us through this chart? And specifically, can we start with the construction of this chart? How is this chart being constructed, and what software have you used here?
So I know some of you are shorter term in your time frames, and I became very interested in looking, because most of the data that we deal with is end of day data and 1 box, 3 box reversal on end of day data, which is remarkably accurate, useful tool. But I became enamored with this intraday data because I know that Wyckoff used intraday swings in stocks to calculate his point figure charts, even though they were still 1 point reversal or 2 point depending on the scaling. So I started to look at the intraday just to see whether or not there was anything there that I could pick up that could be useful. And so I was seeing these accumulation distribution patterns, and they were coming up no matter what the time frame, whether you look at hourly data or half-hourly data. Or in this case, this is 5-minute data. And so I just picked this day at random. So I just was thinking about illustrating a chart for you all. And this chart came up, and here were these beautiful setups on this chart. And you can see here, now this is the Dow Jones, but you can see that there's quite a nice accumulation type formation structure over here. And so we took a count, and it counts 36 across. Now the construction, let's take a minute and talk about that, because the way, and if we have time, we'll go into the website. This was done on stockcharts.com. And so to get intraday data, you have to have a subscription. I think it's just the minimum subscription. Some point figure charts you can get for free. But I believe this intraday data, you need to have a subscription of some type, and it's very reasonable. And so the scaling is dynamic ATR scaling. What does that mean? So it's calculated using average true range. In this case, it's 20 period, which is the default. You actually, with the new changes that they've made in the point and figure engine, you can actually change that data. And so you could change it to 30 periods, or you could change it to whatever you want. And so I started doing it on the default 20 period a long time ago, and was just so impressed with how well it worked. And so so here what I've done is I've done a 20 period dynamic scaling, ATR scaling, using 5-minute data. So it's 20 periods at 5 minutes, and it calculated the box size to be 11.74 points per box. So when you look at the scaling on the left and on the right, those are 11.74 points apart. And so when you calculate, now in this case we count across, so we're counting from the LPS over to the climax. We have 36 columns, and we multiply those. This is 1 box reversal. So we multiply 36 times the scaling, the 1 box scaling, which is 11.74, and this gives us a count of 422 points. So even though we're working with 5-minute data, we still are getting a count here of a robust 422 point move in the Dow from this data. And this is just 2 days of accumulation. And so we can see from the beginning of 5-6 to the end of 5-7, this whole formation forms. And so that's something to be clear about, is that when you're looking at data in this time frame, things happen quickly. And so note that taking the count from the low at 17,739, it gives us a count of 18,161.78 and a upside count from the count line. So we take it from the count line, and it gives us a count of 18,337.88. And interestingly, we're pretty darn close to that level now. And so this base accumulation phase may very well be counting up to the count that we're achieving here recently. So then, after this minimum objective is achieved, we get a classic distribution. And so if you want to do a lot of point figure counting, you want to practice, this is a great way to practice. You can see this in real time, and you can see these unfolding in, doesn't matter, stocks, ETFs, indexes, whatever you want to look at, and you're going to get a lot of opportunities to practice your counting. And so here we have a count that counts across 17 columns times our scaling, gives us 200 points, 199.58 points down. Now, what's important about that is that comes after we get a break, a minor sign of weakness, and then we rally back up one last time. And so that's the reason we take that count. We count across, and it gave us a count that got us within the nesting area of the lows. And then we got after we started to break down, and we had another sign of weakness, we had one last push-up, one box reversal, had one last push-up so we could take that count across. That's gives us 19 boxes, gives us a count of 223 points, and that actually took us to the low of 17,915. So, or maybe that's 17,926. So you can see here that this is pretty darn good set of tools, and this average true range, which I've used hundreds and hundreds of times, is a good method for, it's a good scaling method for counting.
Mm-hmm. Okay.
And for those of you that don't want to do mixed counts, and you find yourself with a stock or an index that's on a mixed count, just go to the average true range, do a 20 period, and get that count, take that count across and see what it does for you. Because it's going to, I think it'll prove to be accurate, useful.
Okay, so Bruce, can we elaborate a little bit on this average true range? A question of how did we come up with this 11.74 exactly?
The point and figure engine that Stock Charts created does the calculation.
Mm-hmm.
And so
it's
all
automatic.
we have to do, it's automatic. All we have to do is select that option, which is dynamic ATR scaling 20 periods. And it'll default to 20 periods.
Mm-hmm. Mm-hmm.
And so then we can choose one box or three box reversal, and it'll all be done for us, and then it'll graph it using that scaling.
Mm-hmm. Awesome. So we have a few variables here: reversal, ATR, and the time for the chart itself. Where we derive the data.
Right. Maybe if we have a few minutes, I don't know if it's possible, but if we could actually go into the website, we could actually see those. It's a very simple interface, and it's very straightforward to use. We don't have to do it this second. Let's get through our other charts, but maybe at the end we can do that.
Okay, sounds great.
So now you can see we've made a higher low, So we got a nice distribution count. It gave us a good count how far down we went. We've made a higher low. And so now, since then, we've actually worked our way back up to another higher high. And so this now is beginning to look like a stepping stone reaccumulation for another count. And so I encourage the attendees to go ahead and pull that up and see if they can make a count out of that.
And it would be interesting if this count right here would be confirmed by this count right here.
Yeah.
So that would give this count more credibility, of course.
So my main point in showing this isn't so much talk about, as to make a call on the Dow or whatever, or an index, as much as it is I want to be able to demonstrate to you all that there's some great tools, and that point and figure works on whatever time scale you want to work with it. And so here's a great tool, and no matter what the time frame you want to work in, you can use the very robust counting methods to be able to help you to determine whether or not, for instance, in this case, think of the richness. It tells you how much potential's in the move, and then that gives you a hurdle rate. If you're a shorter term trader, you can say, oh, there's enough room in this trade for me to put on a position because I have my 3-to-1 reward to risk. My hurdle rate, or whatever my hurdle rate is being met here, or it's not being met. And so there's just all this great, sort of robust set of tools that you have that can add to your shorter term trading. And if you're a long-term trader, what a great tool for being able to help you determine where best is to enter your positions.
Yeah, and obviously, as we scale down to a lower time frame for the entry on the long-term trade, that gives us, a much better sizing with the lower risk. So we can increase our size.
Tremendous nuance in that. And so, I mean, once you can scale down, you might be looking at a 3-box reversal count that counts, much, much higher than this. And then you all of a sudden go, okay, well, let's figure out when and how to buy this. And you start chunk sizing down into smaller time frames. And so it's just, there's a richness of mastery skills that all, the good part is they all follow the same rules.
Okay.
They follow the same counting guide.
All right, so we have a couple of questions here. So question number 1, the count is an equal probability that it will go up or down. For example, if X points counted, it's equally likely it will fall by X or rise by X.
Well,
so I think that, we're going to refer here to a vertical chart analysis where you are determining what kind of potential trend you're going to have out of the consolidation, whether it's going to be up or down. So the usage of vertical charts with supply and demand signatures is going to be crucial in determining, and only then we can take the count and project it in the correct direction. Bruce, anything else here?
No, that's just how I would have answered it. It's just that once you develop, so for instance, in this distribution, you can see that there's this heaviness where you keep breaching the lows of the range, and then there's no capacity for the market to rally there. I mean, it can go back up, it can get back up into the range, but it can't get to the top of the range. And so it's showing classic Wyckoffian distribution characteristics on a very short time frame. And then you go over and you look at the accumulation phase over there, and you can see all, these tremendous signatures of bullish action. Series of, you have a spring, you have a backup, you have an LPS, then you have a jump out, and you have a backup to the edge of the creek. All of those are very constructive, bullish actions. So those are the things that we work hard to develop, is our ability to be able to combine those skills so that we can go from it being an equal probability to having the probabilities fall into our favor.
Mm-hmm. Okay. A question about the stock charts. Does stock charts offer back-tested data, for example, 2002, 2003, on, let's say, Dow Jones Industrial Average? So, in other words, can we go in point and figures to earlier periods like 2002, 2003, maybe even earlier, any data that we can get from the 90s? Are you familiar with that, Bruce?
Yeah, I believe that I do all my historical point and figure work because I have a big database in another program, and so I go back and do it there. I don't tend to do the backward looking with stock charts, but I should look into that. And but I believe that I know stock charts has got a huge database of historical data for vertical charts and line charts. But I don't recall that they have the ability to go back in time on the point and figure charts.
Mm-hmm.
But we should look into that.
Okay, great.
It's just, I apologize, it's just not where I do my historical. I do a lot of historical work on point and figure. I like to look at past cycles because stocks and indexes will tend to follow. If the counts work historically, they're going to tend to work in the future. And so I do a lot of historical work to get a feel for how well counts are working in a stock.
Mm-hmm. Okay. Should we go to the next slide?
Sure.
Mm-hmm. All right. So natural gas. And here what's interesting, Bruce, is you had a lot of great thoughts on how to do the counts in the distribution. So what are the rules, guidelines that you're using for the distribution?
Well, excuse me. Distribution is much trickier to count, and because the tendency is always to take a count bigger than we should, and so in this particular case, there's an example, and then we have another one that we can look at too. But what I've done here is I've done a daily chart, one box reversal. I want to be able to show one box. We've done a lot with 3-box reversal, a little bit with one box. One box is a very good tool, and one box is very good for swing traders. And so for traders that are working in, they're working in months. They're looking for where's the next 3 months going to be, or less. The one box is probably the place to do your work. Here, what I did is I did an dynamic scaling using ATRs, and what it did was it came up with a 45-cent box size. So you can see over here on the left and right hand columns, you can see that these are 45-cent increments. So now what we have, this is a ETN, this is natural gas. And so natural gas made a rather large distribution on the one box method. And so we take and count over, we're counting from the last push up, which is, remember, you only have to have two entries in a column to have a one box. And so you can see here that you go down there's three zeros down and then an X up, and that's right on the count line, so you can't, it's hard to see. But that last point there is the last push up before the markdown out of the range, where it's just a complete, this natural gas just goes into a big downtrend. So this is all preparatory for that markdown. So we can see that when we count over that, you'll notice that I didn't count all the way over to the preliminary supply, which would be this X that's this column of X's that culminates at 2475. Yeah, right over there. And so instead, I come over to this area, this second set of X's. There's an X that a column of X's that peaks at 27. And then there's a big decline, which is like a big automatic reaction. And then it rallies back up again to 27. And then there's an even bigger column of O's down that sets the bottom of the range. It's just huge volatility, which is a change of character. You go from being in a nice uptrend to having this big change of character. Well, I count over to the second column of X's, not to the first column of X's that goes to 27. And the reason that I do that is because I'm trying to find the place where the CO has stepped up and started selling their position. Now, they're selling futures contracts. This reflects futures contracts in natural gas or the cash market. And so you can see here that that first test of the prior peak is as far as I go in my count. And that's still a pretty aggressive count, but it's a one box. We're looking at a one box, not a three box. So we go across to where we have that first test. And so I always count to the test and not to the original high, because that's the first place that it's proven to us that sellers are present and they're selling natural gas from that point downward. And you can see that the next column of O's is a huge column down. There's huge selling taking place. Even though there's another big rally back up that goes to one box above that, still the CO is present and they're selling. So we count, that's where we count to. And so you can see that we have 28 columns, and you can multiply that by 45, or you can simply count down 28 columns from the high. So you can just count down 28, and you can see that we have a count from the high tick and from the count line. And that takes us, just gives us a dramatic count from $27, $27.45 is the high count on this, and it counts down to $14.85 to $12.60, which is a dramatic breakdown in natural gas prices. Who could believe it? But there it is. There's the count. And then it created a stepping stone, and the stepping stone follows the same principles. We count over from the last place that it rallies before the breakdown of the entire trading range. We start there. That's the LPSY. We count across, and we see that count equally matches the count in the distribution range. And the other part that's nifty about this example is the rally that we get. The top of the stepping stone trading range is the ICE, is where all the resistance is in the distribution area. So it gets up to the underside of the distribution area, which is where the ICE is, and that's as far as it can go. And so that would be a classic place to try to short that, short this market. And then it goes down both counts, take it right to the lows, goes right to the lows, slick. And then we take, and we can see here that there's a nice accumulation count, and same principles of one box reversal, so we just count across, and then we either count up that number of boxes upward, or we can multiply that by 45.45, and that gives us a count of 2250 to 2160. And you can see what a nice spring is put in at the conclusion, which is also the low target for the distribution.
All right.
Did I leave anything out?
No, that was perfect. Question.
Let me just say this.
Mm-hmm.
Remember what I said about the spring or the shakeout being that cathartic moment where this natural gas has just been for sale for a long time. This count started to build back at the beginning of 2014. So natural gas has been for sale since the beginning of first quarter of 2014. And it's just down, 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 down. It's just for sale. It's just for sale. And then it gets down here, and right at the lows of these two counts confirming each other, it springs those lows, and then it turns around and it runs back up. And so I think even if, it could spend a lot more time building a cause here, but it came up into the, it reversed that spring and pushed back up, and it's as good a rally as we've seen in this market in the entire accumulation phase. Yep. Mm-hmm. It's as good as that, and it's actually another box above that, I think.
Mm-hmm. And that's what was the question about, Bruce. So you answered it, but let me just rephrase the question here. So how do we know that we wouldn't continue the count to the downside and that we actually, project into the upside? Well, you've mentioned a couple of things here, and just to reiterate some of the points. You talked about downside objectives being accomplished. You talked about a change of character starting from this rally right here. This is the largest rally from this high right here to this low, which suggests change of character, potential consolidation. This rally matches this rally on the potential automatic rally, and this spring situation here is happening right at this objectives. It springs and then rallies right back into the trade range. Bruce, did I miss anything?
Not at all. And we have a meaningful count.
Mm-hmm.
It's a one box count, but it still counts up quite a ways from the spring. But even if we only go up to the high column in this accumulation range, if it is, it may not be accumulation, but I believe that 1665, we may get up to there and then turn around and have to come back down halfway or even more into the trading range, into the accumulation. We'll call it that for now, to build a bigger count for a bigger move. And so it's very possible that's what happens after the spring. So we have to be flexible and ready for anything. But it just wouldn't be surprising, because we have to believe that there are a tremendous number of shorts in natural gas, and that the CO was building a position along these lows and has used the spring to even build their position up even more. And so the CO is the strong hands that are long natural gas, even if it only gets to 1665.
Mm-hmm. Okay. Another question, and this is something that we've already talked about, but let's repeat this. Why and how would we come up with the count that just is so perfectly located in the middle of the trading range? Why this point right here? Why this point right here? Why
really good
this
question.
point right here?
Really good question. Glad you asked it because this is important. Is this last uptick, and we always want to identify this on our chart. So we have our charts which are unmarked up. That last uptick, look what happens right after that uptick. Notice how the market just goes into a big markdown. It's for sale. All of this work, this is the cause that creates this result, which is this big markdown. And so that point is the point that we want to take our count from. And so we take preliminary counts, like go back 2 columns where we have an X from the count line, Vermont. Go over to the count line on the right side.
Right here.
Yeah, right there. And then go back 2 columns.
Mm-hmm.
We may believe that that is where this is going to start from. And so we may actually take preliminary counts starting there and going to the left. And we may take counts. We're looking for potential. But
Mm-hmm.
once we get that last, and we call this the pivot, once we get to that last point, or the springboard, it's another
mm-hmm.
term, is and we start to mark down out of that, that's where we know ultimately where our count's going to come from. And that's also our count line. And so we can go over here to the stepping stone, and we see that we have a three X's up right there, 3 X's up, and we say, okay, this is where we think this is where our count's going to start and go to the left. We don't really know until we mark down out of the stepping stone redistribution area. But we can see as soon as we put in that big wall, sometimes they call this a wall in point figure counting, which is that big drop down, is that once they put that in, you know that that's the X that you're going to count from, and that's going to become your count line.
Mm-hmm. All right.
Very good question.
Mm-hmm.
And you can always tell by looking at what happens after that drop. And once it starts to drop, you go, okay, there it is. That's where our final count is going to be.
All right. Awesome. Okay, so let's go to another slide.
Well, let me just add one more point. Over here on what we're calling accumulation right now, this may go up may work its way higher, a few more boxes higher, and then turn around and come back down again. And if it comes back down and makes an LPS after our spring, and then puts in a big, what they call a catapult wall, which is one of those big giant columns of X's, then that is going to be the place that we're going to take our count line from. So the count that we have there is a preliminary count that is the last O, the last point it drops to before it starts to mark up. But that's preliminary at this point. We
Mm-hmm.
may have a bigger count, and we may have a different count line that we take it from. And so the cord is still out on this as it's moving forward. It's an unfolding picture.
Mm-hmm. Another question. What do you use for a stop for the stepping stones trading ranges? So
Roman, I'll let you answer that.
This example right here. Okay, well, if we're taking the count on this line right here, we're obviously looking for the rally. So we always want to buy on the reaction for accumulation, reaccumulation. And in some instances, we will buy the breakout or a sign of strength. For the distribution, we want to sell after a rally. So any type of confirmation that you can come up with for the change from upswing to the downswing will be your point of entry. There are quite a few possibilities, for the stop loss here. Let's say if our point of entry is on this column early on, somewhere here, we can definitely be very aggressive. We can put the stop loss at the short-term highest point right here as our aggressive stop loss, or more conservative stop loss, defining the actual highs where supply started to come in. We see supply coming in this column right here, and then more on this one. So I personally always look for evidence of supply, because this is where people either start selling or start buying, and this is where the composite operator operates. So if the price were to come back here, then we are most likely completely wrong in our analysis, or we are just completely wrong in our timing for the point of entry. And then, Bruce, I think another interesting question is, let's say that we've established the position here in the stepping stone. We have this objective here. The stepping stone confirms that this objective. We're seeing the reversal here after this rally. So we entered the position. Let's say that we placed our stop loss somewhere here. How would we move the stop loss? Or maybe a question of, in this example, because we have these two objectives, how would we actually define our point of exit?
Well, typically what I do is, this is just the way I do it, but once you have your position on here in this area, and you get the breakdown of the market, and then you have this pause, which comes right at the ice of the stepping stone. That would be a place to put on a second position. So you might put a second position on there, and then you'd move your stop loss down on both positions to a level where if you do get stopped out, you're positive on the whole trade, marginally positive on the whole trade. So I would calculate that, and I would put my stop above that, or below that. And then if I'm only going to keep the position on, I have a full position on, I'm not going to add to it, then what I would do is I would try to figure out the break-even place. Once you're down out of there below the ice, I might move my stop down to where I'm marginally break-even on my one position, with the intention of trying to get to the objectives that are set by the stepping stone and the distribution. So that would be the way I would think of it.
Okay. Yeah, similar logic for me here. One thing that I want to stress here is, once we are putting on the second tranche right here, I would usually look for the confirmation of the commitment to the downside. So that would mean that the price goes below the support or the ice right here for this small, trading range right here, and actually commits to the downside. Then it's, you're going to have more confidence of moving the original stop loss, from this area to somewhere here, because the price commits. If the price commits to the downside and then it comes back, you're going to close this position. In some instances, you might think that this could be an upthrust action, and then we still can potentially go lower. So the movement of the stop loss is not only determined by when the price starts to move, but also, as Bruce was saying, you have to be a little bit careful and think that a potential upthrust in this area right here as a stepping stone for this move can happen in this manner as well. So you have to put the stop loss appropriately, give it some room, don't be very close to the short-term resistance right here. And then on the way down, because we have two objectives that are confirming each other, I would start looking for the evidence of some kind of intermediate climactic action. And for the short position, I usually prefer not to go into the consolidation, especially after the change of character. So a climactic action with the elements of increasing volume, increasing spread, increasing velocity to the downside, elements of fear and mini panics or panics, would be sufficient evidence to start scaling out of the position. And in a lot of instances, that climactic stop in action will be one of the best prices that you will get out of the short position. And also think about, the effectiveness of your capital usage. So if you are still in a position in this area right here, you might be gaining a little bit on the price here, but what you're losing on time. So you could be more efficient trading something else that is trending either up or down. It doesn't really matter. And you are not staying in this position, especially in the area where you are expecting some kind of consolidation. All right, Bruce, should we go to the next slide?
Sure.
All right. Okay, so I really like this case study. And again, Bruce will talk about supply points and distribution counts. And I thought that we need to stress this out during this session. So Bruce, please walk us through here. This is obviously the vertical chart.
And this is an upthrust after distribution, which is a type of a distribution which ends with an upthrust, and then there's a final thrust to a new high, and then after that you just have a breakdown back into the distribution range, and then from there it's sort of like a spring in reverse. It's a spring or a shakeout of an uptrend rather than of a downtrend. And so the thing to notice about this, without getting too much, you can study this. This is a talk that I did for ChartCon up in Seattle, and notice that the characteristic is that you're starting to see big spikes of volume on the declines. And so especially when you see, one of the most important things is when you see an upthrust and then you see it try to come back into the distribution area, and you see a signature of volume expanding as that's occurring, then you want to be very, very cautious, because upthrusts can be among some of the most dramatic declining patterns, where we have this LPSY here that occurred, which is a classically weak LPSY, where there's very little lift in it, and the volume is marginal, and then it starts to resolve itself with huge volume coming in as it starts to break the LPSY level. That's huge volume. Is that sometimes you don't even get that in an upthrust. You get something that's akin to maybe like 3 or 4 periods, and this is all these are weekly bars, so this is a huge pattern. Anyway, so just some comments about upthrust, because they're quite dramatic, and you get the big volume signatures as they start to come back in, and you want to just, if you're long, you want to start to get small and tighten up your stops, and just be very careful. So I guess that's all I want to say about that. But this is a classic case study.
Okay.
And certainly study it on your own, when you get these slides.
Yeah, definitely. Very good case study right here on the distribution. For those of you who are attending my advanced Wyckoff classes, look at the slope and resistance right here in this area for the trading range. So we want to operate on the principles, of the methodology, and we want to find that LPSY after a sign of weakness. Now, if we would look at the more horizontal range, we see that this low still creates a high low relative to this one. So you have to experiment a little bit and do both horizontal and the slope and structural analysis. So visually, I see that all of these points right here, they are points of resistance, and they are somewhat on the same resistance line. So I want to project this line, and I see how nicely now the upthrust is just committing in one bar, and this is weekly. So 1 week it commits to the upside, and then almost instantly, as Bruce said, as a reversed function of the spring, reverses, has a small test right here, and then out of that test, this could be a very aggressive sell right here, you know, on the break to the downside, or just the reversal of this last attempt to rally, and obviously, you know, this rally right here. But what's nice about this slope and resistance here for the trading range is that if we are using the Wyckoff principles and we're saying, okay, this is our resistance, let's project the parallel for the support, we're using automatic reaction, and we see the support line actually gives us another points right here, and then we have a sign of weakness. The first break below the support with the price rallying back into the trading range and subsequently into the upthrust action. So we would project the parallel the same way. And now we see that by our principles, after phase C in upthrust action, what we want to see is a major sign of weakness where the price travels from the top of phase C through the whole trading range. It undercuts the support cluster that we've created using the automatic reaction and this sign of weakness in phase B. And we want to see the commitment of price below that support cluster, which we see here. And then we want to see that very weak rally. And usually it might come with 2 attempts to rally. The first high and then the second one, the test of the first one. And you might have different structure here. You might have a stronger rally or a weaker rally. So depending on which one, you can determine your trading strategy at the time. But once we are starting to commit, we are bouncing against this resistance which acted previously as a support, and then we are starting to commit to the downside. This is a very aggressive point of entry for us. And please note, on the horizontal, we still would be in the trading range, but here on the slope, we are definitely out, and we showed that this is our major sign of weakness. So just, you know, this, I wanted to give you guys this visual, a slightly different perspective as to how we can look at the major sign of weakness and, you know, LPSY. It just gives us more confidence, you know, to enter earlier on.
A point I would make about these peaks, the buying climax, secondary test, 3 secondary tests, and then the upthrust, is that I go back to the point that we were making about the Dow Industrials, is notice how much time is spent at the top where you drew your trend line, but or my horizontal line, either one. Notice how much time is spent at the top of the range. And so this brings great comfort to the people that own the stock because the stock keeps making new highs. But at the same time, the CO who is clearly starting to distribute their shares is using all this time spent at the top of the trend channel or the trading range, however you want to look at it, is using those periods to distribute stock, and which becomes quite evident much later on.
So talking about the current action on the Dow and other indices, so if we're looking at the potential upthrust scenario, we should anticipate that the price is going to commit to the upside, but for a very short duration of time, and then almost instantly it will start falling back into the trading range. And on this fall, if we're thinking distribution, we want to see the structural damage and that would be, the commitment below the support. And with that, we want to see the increase in the spread, and also we want to have some kind of supply signature that would confirm that movement to the downside. So those are the elements for us, to look for in the distribution scenario.
And I have seen upthrusts where it's been able to get above the distribution range and live there for a period of time.
Yes.
Not really making any meaningful progress beyond that, but was able to live up there for a period of time before coming back in again. And so it doesn't have to happen like up and then back. It's not, that happens, but it gets up there and it could spend, like here, you could argue that this spent 6 weeks from the last secondary test. It spent 1, 2, 3, 4, 5, 6, 7, 8, 9 weeks up there, just hanging out. And so that would, while it's at new highs or hovering near new highs, there's complacency. But at the same time, if you know what you're looking for, this is a very dangerous situation. And what you want, if you're a bull, what you want is to have this stock or the market start to move away from that area, just plot along and get away from that stepping stone area and start to make new highs and show that it wants to just keep going up. If it starts to stall out, that's when you would become concerned and say, maybe this isn't a jump, a new markup, the beginning of a new markup phase. It's an upthrust.
All right. Well, let's go from here to the point and figure chart.
This is a very good point and figure case study. And the point I would want to make here is that, and it goes back to a prior question, is that what you're seeing there in the structure of that whole area that we evaluated is how much of it we're actually counting. And so you can see that you've got to be very, very careful about how much you count in distribution, because if you count too much, you're going to get nonsensical numbers. You'll get numbers that go negative. They go below zero, and those are of no value. And so here we have two counts that we're taking. Remember that everything over 100 is 2-point scale, and so it's a mixed count, and everything below 100 is 1 point. And so we have this one count here, which goes, it's a mixed count, but it goes back 5, 6, 9 columns. And those 9 columns count down to 75, which is where it stops at the bottom of the trading range, and it counts to 66. And so you can see that that's a good intermediate count. And it stops there and actually creates the LPSY action, which is a drifting up to set an LPSY before the big markdown occurs. So you can see the change of character here from the upthrust down to the bottom of the trading range, the distribution range. You can see how easily it moved from the top to the bottom. And so the point that you take this count from is we literally counted only the part that's the upthrust above the top of the secondary tests. And that gave us a good intermediate count, very meaningful count, counted from, and you can see that, notice the last column of X's up before the big wall is created where it just goes into a big markdown. Persistent markdown is that last column of X's. We count over from that, and we count across. And so we count over to the place where we had the prior wall up, and then you had a little sign of weakness, and then the final high. And so you take that count, and look at how big that count is. It's a huge count. And so then you turn around and you take another count. Now this is the one that I really want to emphasize with you, is that when I'm taking distribution counts, I want to get counts that are going to be useful and accurate as best as possible. And so what I do is, there's an old saying on Wall Street that the composite operator will mark stocks up, and they'll mark them up as long and as far as they can. They don't know how high is when they mark them up. And then they will only begin to sell stock on a scale down off the peak. And so that really stuck with me, and I use that logic for my counting, because the point at which we make our final high and we start to mark down in a persistent, consistent way is the point at which I want to take my conservative count from. So what I've done is I've found the final high, and then I go over to my LPSY and I count for my LPSY, and you can see there, this is the last place it rallies to before it marks down out of the LPSY range. So I count from there, and I count over to the high, and that becomes my count line and my count. And so then, and I know that's going to be a big count, but everything that occurred from the peak over, we know that there's large active sellers selling stock on a scale down off that peak. And so that's the reason I use that place. And I know it's going to give me a big count. So I take that count over. It's a mixed count. So it starts at 118. And my count line is at 92. And so I count that across. It gives me an objective of $40 from the high and $26 from the low. There's my target. And it got very close. It got to $29. And so the emphasis here is why it's important to be very judicious and conservative in your distribution counting. Because one, you want them to be accurate, and two, you want them to be useful to you. And so always undercount. Always be careful to undercount, because the textbook would be to take on this is to count all the way across, and that probably count to minus 500.
Right. And that's what I wanted to talk about a little bit. Why are we even having the discussion? Why is it that the counts for the distribution, should be approached differently? Well, because of what just Bruce said. If we would just go and do everything by the count guide, we would identify the last point of supply, or we're going to say, okay, most conservative count would be an upthrust action right here, and we would go to the area of the climactic action and would count all of this, or would count all of this from the LPS to the buying climax. So, and it's definitely going to go into the zero and below zero. As we see, this small count right here is producing already, the maximum target of 25. So Bruce is talking about how do you actually minimize the count and make it more accurate. And I really like the logic, Bruce, as you are saying that after the high, we are starting to see the actual sell-in supplies coming in. And we can see this from the columns, from the down columns right here, how reactions are increasing relative to this last swing right here. And it makes a lot of sense. It makes a lot of sense. Also, another point that I want to make here, which is very nice, we're thinking why this count is so small. Well, think about this area right here, upthrust, as a small trading range by itself. So we have some kind of distribution here. It's very small, and this is a small cause for this move. So whenever I do point and figures, I always want to see the most conservative count confirm my sign of strength or a sign of weakness move. And when it does, it's just such a great confidence builder, that I'm using the counts correctly, because your sign of weakness or sign of strength is going to be your first target out of the most conservative place. So that's just nicely demonstrated right here.
Also, there's some confidence that we have in that small structure up there, because notice that at 108 is the last point of supply, minor last point of supply in the up thrust, and that the push up, that big column of X's that pushes up to 108, where we, on the left side of our count line, they equal each other.
Mm-hmm.
So we see that this is where we stopped. We went from 108 back down to 96. So that's like that's a pretty good pullback, and then a push up to the highs, and then another big sign, another big pullback. So we can see that there's just, there's active sellers up there. But all we're trying to do is just grasp whether or not we, what kind of account we would have here, and they equal each other. LPSY equals PSY is sort of the principle at work here. And so we just say, this is a tentative count, small, it's conservative, let's see where this goes. And it kind of the structure kind of makes sense. You can see it's pretty, it's a pretty robust distributional structure, even though it's on a very small scale.
Mm-hmm. And let's see what has happened afterwards. So we were here. These are the two counts: up thrust, LPSY.
Yep.
And we are obviously, in the area where our objective takes us. And we have some kind of V bottom information right here, with a change of character in this rally right here, sign of strength, LPSY, I'm sorry, LPS right here. And then your, obviously, if we would measure it, I would assume that our count would be something like this.
Yep.
Across, maybe even, depending on, this is probably would be the most preferred count. And then we have the new formation right here, Bruce. And then again, I see that, these reactions, are of the same magnitude right here. So a change of character starts to happen in this area right here, but your count for the distribution is only in this area right here.
And so I would point out here that, again, we're taking the count, what appears to be the LPSY, and I'm counting over. Notice I'm not counting all the way across. There's a push up to the highs at 99, and then there's a pullback and another attempt to push up to the highs. That first test of that 99 level, not the first touch, but the second touch of 99 is where I count to. And so who knows if that's going to be right or not, but that I know that what came subsequently after that was a big sign of weakness, a big break from 99 down to 85, and then a little push up, and then another drop down to 81. And so there's a quite a bit of weakness there. And so that tells me that now large interests are selling stock. And then they rally it all the way back up to that prior high again. And so, and they can't get it any higher than that. And so this is as much as I'm willing to count.
Mm-hmm.
Is that far is the test of the high touch over there at 99. And so you can see that gives us a count down to $49, 49, and then 53. And so And now we have a pause, and you can see this pause that we're in now. We haven't fulfilled that yet. But notice that this pause, it doesn't have any lift to it. It's below the areas of support back, all the way back over at the beginning of 2014. Yep. It's like it just can get up into the bottom of that. It's as far as it can go. And so this so far is looking pretty punky to me. So we count across there. It doesn't give us a count back down to the other count, but you know, this may not be done yet.
Yeah.
There may be more coming.
Mm-hmm.
Yeah.
Yeah, so this could lead to this area as well.
And that might be an opportunity as a case study for students to
timing tool.
Do the timing tool feature on distribution.
Mm-hmm.
So I wanted to just show you this because I thought it was a good example of how to conduct distribution and how to be really careful in your counting.
Mm-hmm.
And you just have to do a lot of it so that you get a feel for how far to go. But me, I like to either go to the test where it's basically can get to a prior high point or maybe a bar above a prior high point, and then weakness shows up. So always I'm looking at, oh, look at the weakness that came after that. So there's this stock is for sale, and it rallies all the way back up to the highs again, but that weakness is a change of character, and then it runs back up to the highs and tries to test that one more time. Well, now you have something to count, because everything that came after that was selling. So I'm basically, again, the principle's the same as what I showed you over on the left over here, which is I went to where the buying that stopped pushing up and making new highs, and at that point it showed a willingness to drop, and it showed that there were large interests selling stock off that peak. And so it's really the same principle. The only difference between the picture on the left and the one on the right is on the left we've made an LPSY at $92 at a much lower price point than 118. And on the right, it got back up to that prior high before it broke down again. So, but in both cases, the principle that we're counting with is the same. The same logic applied to both.
Mm-hmm. Mm-hmm. Okay, great. Bruce, I think we are at the point that we're probably going to stop, but I would entertain any questions at this point. And while we're waiting for the questions, let me ask you a couple of things about the point and figures. And maybe this is going to be a repetition for us, but let's just talk about this. In your personal trading, how often do you use point and figures?
I use it for everything. As a matter of fact, a thought came to me earlier in our discussion is that if somebody came to me and said, you have to only use either point figures or vertical charts because you're using too much paper, you're printing off too much stuff, and we're only going to limit you to one or the other, I'd probably take point figure.
Mm-hmm.
I think I could survive with just point figure.
Okay.
I love the verticals. I look at them a lot, but I always want to look at the point figure charts.
That's a very interesting answer because of a couple of things. Well, first of all, the question that we have is, can we just look at the market structure in point and figures since it seems to give good insight, or do we still need to look at the vertical chart? So that was the question, and you answered it right away.
There's a lot of information that we get from vertical charts, especially as Wyckoffians, that's really useful. And so obviously the good part is we can do both, especially if you're in the nascent stage of being a point figure analyst. Spend more time with point figure. You already know how to do the verticals. You're probably very proficient with the verticals. The point figure is where you need repetition because it's unusual, it's weird in relationship to what we're used to because it's based on volatility. but the more you count, see, my principles about how to count distribution came from my experiences. And so I have an innate sort of a sixth sense about where to count from and count to, but I try to make it rules-based. You know, I don't just make stuff up. And so you can see that I always know exactly where to start my count from on the right side. And that's classic Wyckoff. And then the only thing is, how far am I willing to go to the left? And so, and you can go, here's the other thing is with one box reversal, because we're on this chart again, you can go further to the left than you can with 3 box, because 3 box is compressing the data more. So you can see more. So it's you can be a little bit more liberal in your counting across on a 1 box, because you're actually looking at really less data, lesser time period.
On this chart, the question was, Ramon seems to use longer count range than Bruce on the accumulation on the right side. So I think that we're talking about this trading range right here, and I think that through the discussion, we were talking about the continuation of this upswing as a potential sign of strength, then coming back to maybe 1/2 of the point, and then as an LPS, and then resumption of this trend. So our count would increase, and we can take this count across from this LPS point, and we can go even further up to this point right here on this line.
The reason, now, I'm always trying to establish the most conservative count for a hurdle rate. Okay, so I'm trying to be cautious in my counting. But the reason that I counted to where I did, and I should have said this earlier, is that notice that low there, the furthest O in my count, which is just straight up from the 2015 marker over on the left side, all the way over on the left, Ramon.
I'm sorry. Which one?
Yeah, find 15 there, and then look straight up to that. That's
right here.
Yeah, right there. That one is the reason that I started my count there, was because look at the change of character. Look what happened. Even though it spent a couple of columns going sideways, then it had a big automatic rally. So I assumed that was the end of the decline. It wasn't over here where this big column is. It was where this was. So I feel that is the place where the change of character occurred, where demand showed up. And so I go, oh, this is where the demand is. This is where I'm going to count to. And it's a more conservative count. That doesn't mean I can't make a more aggressive count later. But that's just experience. It's just, where does the demand showed up. That was as low as they could get it before there was a meaningful flexing of the muscle of the bullish case, where there was demand that came in and was able to set the top of the range. I'm assuming that's the top of the range right there, where you wrote AR.
Okay. Another question. Okay. Since stock chart does the dynamic count based on price 100, doesn't then TradeStation give an incorrect count, since box size does not adjust based on the price, or it's just preference by the user?
Oh, here's the answer to that, and I've been through this in a zillion different ways, is that the beauty of point figure is that it's organic. If you change the scaling of the boxes, go half point, you're going to get twice as much volatility. If you go 1 point, you're going to get half as much volatility. They're going to come out in the wash. They're going to, however you set up the scaling on a 1 box or 3 box reversal, it's going to automatically adjust itself and give you the proper number of columns. So don't worry about that. If you've got one box reversal on TradeStation, or you do half box, whatever you do, it's going to just automatically create the right number of columns for that. So you'll be counting twice as many columns at half the value. So half point times twice the number of columns. Or if you do 1 point, it's going to do half the number of columns. You're going to end up in the same place.
Mm-hmm.
I hope that makes sense.
Yeah, and I'm a heavy user of TradeStation. I also use stock charts, mostly for vertical charts, but TradeStation I use for point and figures as well. So yes, there is this limitation where you have to understand where you are price-wise, above 100, below 100, and then adjust that box size, depending on the price.
Or
so,
don't adjust it. If you end up at 120 and you're using one box reversal instead of going to two, it's going to work. That's the beauty of it. It's very organic, and so the counts are going to work. And so just not to worry, not to worry.
Mm-hmm. Well, having said this, my personal preference, and Bruce, this is just me, once we go above 100, I usually adjust it to $2, and especially if the whole trading range above 100, it's just easier to count. And in my experience, and just even, we went through this with what was Apple, right? So, more recent data on Apple, we were looking at the stepping stone right there. And as I was preparing the counts there, the 1 point count undershot the objective, and the 2 point count actually gave a very accurate objective, really within like $2 or $4. So I think that it's definitely a personal preference. I think that you can go both ways. And I think that you have to gain experience, as Bruce kept mentioning this. You have to, it's a very experiential way of analyzing. You can't really just like take the count guide and be accurate from the first, second time. You have to practice that, and only through reiterations of going through stock to stock to stock, count to count, you will gain that insight as to how exactly to do this. And obviously, all of the material that we gave you during these 3 sessions is just crucial. I actually had a question recently as to, and Bruce, let's just talk about this. For the point and figures, what books would you recommend? I mean, definitely Jeremy Duplessis's book on point and figures kind of like is considered almost like a Bible on the point and figures. Are there any other sources on the point and figures that, books or maybe articles that you would recommend?
So many of them are focus on the vertical.
Yes. And that's the thing. So I would probably go to Hank's articles, where he has almost in each article that he publishes, he has some reference to the point and figure chart.
Is it, I'm trying to think of the person, is it Delvalier? I may have that name wrong. But there was somebody who was a contemporary of Wyckoff's who wrote a book on point figure counting on horizontal method. And then also I've got a series of articles that were written back in the 50s on point figure counting that were on the horizontal method. And the book is out of print. It just so happened that I managed to get my hands on one years and years and years ago. And but some of the better stuff out there is really, really old. And so I will look up the name of the person that was Wyckoff's contemporary, and then also the other book. But I think that book, if you can find it in a reprint, they're like, it's like over $100. So, but I'll look. I'll try to find that information, and then we'll have that for you when we meet on June 1st.
That's true. Yes. So we can do that.
And we're going to be able to actually, you're going to be able to talk to us, and we're going to be able to talk to you, and we're going to have fun. So what could be more fun than talking about Wyckoff method?
Nothing else.
Yeah,
Tom Dorsey, obviously, yes, another, a big authority on the point and figures. And both Tom and Jeremy, talks about, horizontal count. But, I actually think that probably at Golden Gate, with the classes that we have, with the teachers that we have, somebody like Bruce, and with the experience that Bruce has, we probably have the most advanced knowledge on the horizontal counting of, point and figure charts. So I would just, study this material again, listen to the recordings, go through the slides, make notes. As I usually ask you in the classes to do, make notes, and this is how you will retain most of the information, and then practice. Go create those point and figure charts. Take one campaign, go to the original trading range, look at the conservative, aggressive objectives, start moving forward as the price goes up or down and creates a stepping stone. Figure out, what are the counts for the stepping stone? Do they confirm the original counts, and so on and so forth. So you have to practice. And this is what Bruce have done so many times, and this is what I've done when I was studying, at Golden Gate. Literally, we would just, I would just take the paper and, would draw point and figures, taking the data from the vertical charts, especially for 1 point reversal. Back then we didn't have all this software that allowed us to do this. So practice, is extremely important in this whole journey. Bruce, I think we're going to stop here. I am really grateful that you were able to join us for these 3 sessions. Your insights are so unbelievably great and awesome. Every time you talk, I pick some things that I haven't thought before. So it's just such a pleasure to teach together with you and just to have this dialogue. And I'm looking forward to other sessions that we'll have in the future.
Well, I love to work with and study with my Wyckofian sisters and brothers, and this is a great way to do that. And I look forward to our session together on June 1st. And I think that's going to be a lot of fun and a little bit more, maybe a little more informal. And but I've enjoyed every minute of it.
And as long as we're making this reference, June 1st, so this is at the end of the recording, so we're just probably going to edit this out at some point. But let's talk about June 1st, because some of the people did not join us at the time. So for this group, we want to create a bonus session, and because there were quite a few questions that were not directly related to point and figure analysis, and they were more related to just general questions on the methodology. So we want to use this opportunity on June 1st and to have an open mic session where all of you can, we're going to unmute you and you can talk to us and ask the question or questions, and we can together go through your case study so we can answer the questions. We can, talk about what are the best possible solutions, to the problems that you are bringing to the table. And it's going to be the same time slot on June 1st from 4 to 5:30. This session is not going to be recorded, so we're going to share freely, or rather, it might be recorded just for my purposes. but it will not be distributed. So like as usual in our classes. All right. Well, Bruce,
Thank you all. Yeah, thank you. And I appreciate everybody's involvement, and I've had a great time.
Thank you so much. I had a lot of fun too. And to everyone, who attended the sessions, thank you so much for signing up. And we're just looking forward to seeing you in other classes and other sessions. Happy trading, everybody.
Take
Thank
care,
you so
everybody.
much.
So long.
Bye-bye.